Understanding credit. What is credit? What is a credit score? The credit score is a rating that financial institutions utilize to assess the risk and determine a borrower's ability to repay a loan. The individual's credit score is important to maintain overall financial wellness and enjoy the higher standard of living possible while striving to reach your financial goals. Achieving and maintaining a high credit score will lead to access to affordable credit and save money on loan interest payments. A high credit score will lower your rates and save you money on loans like mortgages, auto loans, and student loans. This increases your spending power and increases your standard of living. In this module, we're going to help you understand what goes into a credit score, how to increase your credit score, and how to maintain a high credit score. Credit basics, understanding a credit score. What is a credit score? The components that make up a credit score, why a credit score is important, the costs of a low credit score, and how to improve or repair your credit score are the topics in this module. What is a credit score? The credit score is a rating number that financial institutions utilize to assess the risk and determine a borrower's ability to repay a loan. KYCC is a common thing I like to refer to. Know your credit score. It's important to know where you stand with the credit bureaus. 10 billion credit decisions are made each year utilizing people's credit scores. There are 5 general components that are considered in determining a credit score. Most banks and financial institutions use credit scores to decide whether to extend credit to a potential borrower and what interest rate they will charge. 2 main components of the credit score are how a borrower has repaid lenders in the past and how much available credit is being utilized relative to the available credit reflected on their credit report. That is commonly called a debt-to-income ratio. Having and maintaining a high credit score is a main component of creating overall financial wellness. The 5 components that make up a credit score. We're going to go over each category in more detail later in the presentation. Payment history, 35% of your total score. Credit utilization, 30% of your total score. Length of credit history, 15% of your total score. Credit mix, 10% of your total score. New credit, 10% of your total score. In summary, it's very important to have established credit. It's very important to not have late payments, and it's very important to have less than 30% of your current revolving debt being utilized. Payment history, 35% of your total score. The borrower's history of repaying past debts is the most important factor in calculating a credit score. This is the most important piece of the credit score puzzle. This includes repayment of past installment loans as well as revolving debts like credit cards. Credit bureaus indicate that defaulting on larger installment loans like mortgages will damage a credit score more severely than defaulting on a smaller loan like a revolving credit card. One of the best ways for a borrower to improve their credit score is by making consistent on-time payments. Banking technology can help maintain on-time payments by creating alerts, payment reminders. The bottom line, it's very important to pay your bills on time. Credit utilization, 30% of your total score. This is the borrower's outstanding revolving debt utilization ratio relative to their overall credit limits on their credit report. The total amount of debt currently utilized relative to the borrower's total available debt listed on their credit report, how much available and how much is currently being used. This is very, very important for the credit bureaus to calculate a credit score. The experts recommend that the amount of debt owed on your revolving limits is less than 30% of your available limit. It is very important to plan major purchases to keep your revolving debts or credit cards as manageable as possible. If your revolving debt balances are high, if you have an unexpected expense, making more than one payment per billing cycle will help get this ratio down. Also, it is acceptable to utilize the emergency fund or short-term savings to pay down the revolving debt. Length of credit history, 15% of your total score. This is based on the length of time each account has been opened since their most recent activity. Basically, how long have you had the established credit account? A more established credit history provides more information and offers a better picture of long-term financial behavior. To improve credit scores, individuals without established credit history should begin using their credit. Make a charge on your credit card and pay the balance in full each month if possible. This shows the credit bureaus that you have the ability to utilize and repay credit. Individuals with established credit should maintain their long-standing accounts. Don't get a new credit card and close your old one. The sooner credit history is established, the better it will be for your credit score. If you establish credit while you're young, even if you don't use it that much, it will help your score in the long term. When you go to buy a house, you'll get a better mortgage rate. To establish credit, you may need a cosigner with a borrower that has limited or no credit history. Secured loan products are also available to help establish your credit when you don't have any. Credit mix, 10% of your total score. Borrowers with a repayment history of a variety of different debts indicate a borrower can manage their debts if they're paid on time. It is important to establish and utilize revolving credit or credit cards. If you don't have a credit card, it actually really hurts your credit score. It is helpful to have a repayment history of installment loans as well as revolving debts like credit cards. Credit bureaus have stated that their historical data indicates borrowers with a good mix of revolving credit and installment loans generally represent a less of a risk for borrowers because they're going to have a higher credit score. New credit, 10% of your credit score. Borrowers should avoid opening too many credit lines at the same time. This could suggest that the borrowers experience financial difficulty and may be a high risk to a lender. It is recommended that borrowers only add additional credit when it is required or when it makes sense financially. It is acceptable to utilize multiple store credit cards if the balances are paid off at the end of the month. The store credit cards offer substantial savings and you will save money. The store cards also offer low limits, available limits, so it won't reflect a big available balance on your credit report. Summary. There is no exact formula on how to calculate a credit score. One of the main components of a credit score is how a borrower has repaid lenders in the past and their history of repaying loans. The other main component is how much of the credit is being utilized relative to the available credit reflected on the credit report. It is also important to pay creditors on time and not be past due, especially over 30 days, 60 days, or 90 days. It is important to have an established credit history. It is very important to have a mix of installment debts as well as revolving debts like credit cards. It is also recommended that less than 30% of your available revolving debt limits are being utilized at any point in time. Why is a credit score important? A credit score is very important because most banks and financial institutions use credit scores to decide whether to extend credit to potential borrowers. The banks and financial institutions also use the credit score to determine what rate they will charge the borrower for the loan. Many employers conduct credit checks on potential candidates. Many insurance companies conduct a credit check on their customers. The cost of higher rates and insurance costs may dramatically affect your financial situation, thus impacting your overall financial wellness. The cost of a low credit score. Employment. 47% of employers view credit history during the interview process. A low credit score may actually make an applicant ineligible for certain industries and jobs. Home buying. Lenders review credit score to determine the ability to purchase a home. A low credit score could affect the ability to purchase a home. A low credit score will also affect the rate the mortgage company will also offer the potential borrower. You will pay a higher rate with a lower credit score. Rent. Many landlords view credit history to determine their rental agreements. Higher loan rates. The interest rates charged by most lenders is determined by the credit score. Higher insurance rates. Many insurance companies are now basing their rates on the customer's credit score. The lower the credit score, the higher the rate on their insurance. The cost of a low credit score on a home purchase. We're going to assume a $200,000 house is being purchased with someone with good credit and someone with lesser credit. The person with good credit is going to get a 30-year mortgage at 2.99%. The person with lesser credit is going to get a mortgage at 3.99%. The person with good credit is going to have a monthly payment of $842. The person with lesser credit will have a payment of $954. The person with good credit will pay about $103,000 in total interest over the term of the loan, while the person with less credit will pay $143,000 over the term of the loan. This is a rate of $112 per month for the lesser credit person, and they will pay $40,000 more over the term of the 30-year loan. The cost of a low credit score on an automobile purchase. A $20,000 car with someone with excellent credit, and we'll assume a $20,000 car with someone with lesser credit. For a 5-year loan, the person with great credit is going to get a rate of approximately 1.99% for 5 years. This will have a payment of $350 a month. The person with lower credit is going to pay at least 6.99% for 5 years and a monthly payment of $396. So the person with good credit is going to only pay $1,028 over the 5 years in interest, while the person with lesser credit is going to pay $3,756 over the same 5 years. This represents only $46 a month, but over 5 years, it is more of a payment of $2,728. So as you can see, it pays to have good credit. The cost of a low credit score for insurance policies. Many insurance companies now base their policy costs or prices on one's credit. Homeowners insurance. Many companies have 10 to 15 tiers of pricing based on the credit score of the homeowner. The estimated average homeowner insurance policy cost is $1,000 a year with someone with good credit and $1,900 with someone with below 700 credit score. That's $900 a year just for having good credit, or $75 a month. Automobile insurance. The estimated average automobile insurance policy costs about $1,320 a year for someone with good credit, or $110 a month. Someone with 600 or lower will pay approximately $2,040 a year, or $170 a month, which is an additional $60 a month, or $720 a year. As you can see, even items like cars and insurance will cost you more with a low credit score. The actual monthly costs of having a low credit score. With our $200,000 mortgage cost, you're going to pay $112 a month. With our auto loan, you're going to pay $46 a month. With the homeowner's insurance, you're going to pay $75 a month and $60 a month more on your auto insurance. Your credit cards, I have not even taken that into account, but credit cards rates with people with low credit scores can be over 20%. So your totally monthly cost is about $293 just by having a low credit score. That's an annual cost of $3,516 after tax. If you're in the 28% tax bracket, you have to make $4,500 a year to pay the additional cost just for having a low credit score. So as you can see, having a high credit score is very important, and over your lifetime will allow you to increase your standard of living, save a lot of money, and have a nice lifestyle. How to improve or repair a credit score. I deal with a lot of people that do not know how to fix their credit. You start with reviewing your credit report, reviewing your credit history. Annualcreditreport.com is a free website where you can get your credit report from the government once per year. You can identify the issues causing your low credit score and also check for possible errors. Credit counseling is available. Banks, credit unions, and financial advisors can help you look at your credit report and review what your issues are. Credit repair. There are credit repair companies, but credit repair is actually simply identifying and resolving issues on the credit report, and you can do that by yourself. You can dispute and resolve issues on your own. You can also utilize a credit repair company for help with a fee. Research the credit repair company and make certain it is a reputable business. There is a lot of fraud in these types of industries. I can also help you with that if you do need help. Mistakes in a credit report. Mistakes do happen. How to resolve a mistake on your credit report if you do notice there is a mistake that is affecting your credit score. You'll notify the business in writing that there's a mistake. There is a sample letter on the FTC website. That's the Federal Trade Commission website. You'll include a copy of the disputed item and a copy of your credit report. You'll also notify the credit bureau in writing identifying the mistake. There is a sample letter on the FTC website as well. You'll include a copy of the disputed item and a copy of the credit report. If the dispute is not resolved, the credit bureau will make a note on your credit report, which will help your credit score. If you have any questions about how to increase your credit score or don't know how to go about increasing your credit score, I'm available for assistance and questions. Please give me a call. I'd love to help.